Good morning and welcome everyone to the Moneycontrol live stream. You're watching markets with Santo and CJ. Well, we have a big earning in the spotlight today. Larsen Toubro came out with his Q2 numbers, and Santo, I think I see a broad smile on your face.
Well, no disputing the numbers, no room for arguments there really.
Oh, come on, I have a lot of arguments. Don't worry about the arguments, Santo.
Well, when it comes to a company like L&T, it's all about the order book, and on that front, the company has clearly delivered close to a 24% uptick in order intake for the quarter, which is more than what the market was expecting. And besides that, on the whole, the numbers were slightly ahead of analyst estimates, mainly because of better execution. The combined order book now stands at close to about 3,72,000 crores. So there is clear earnings visibility there. And most importantly, the management has now said that it's most likely it will hit the upper end of the order flow guidance for FY23, which is about 15%. Another trigger for the stock could be the planned divestment of L&T's road business, for which the management is awaiting some approvals, but it's likely to happen in the near future.
True, Santo. I think if you look at the consolidated numbers, they were, Blockbuster, as I said, earlier. But I think what I really was a little worried by is the standalone performance of the company, which is basically the core EPC business. If you look at standalone margins in the September quarter, they came down about 59 basis points to about 7.4%. Even gross margins also saw a decline, which is basically indicating that company is continuing to face cost pressures. I mean, the decline that we have seen in steel prices, even some of the other products that are usually used in execution of project by L&T, they are all, despite all of that, there has been a decline in EBITDA margin. It will be important to see if this EBITDA margin, pressure that the company is currently seeing, Santo, it continues in Q3, because then that could become a little bit of an issue as far as investors are concerned. Apart from that, if you look at the standalone net profit growth, that is about 9.9% on a year-on-year basis for the second quarter, and that has also largely come on the back of a 21% jump in other income in this quarter. So clearly, the standalone business, even though the order book seems very rosy, the revenue guidance and order inflow guidance is very, very optimistic from the company. At this point of time, I'm still not seeing it in the numbers to justify the sort of crowded trade that L&T has become. I mean, the stock has almost 99% buy calls, almost on par with ICICI Bank in this market. So if you were blind and you were asked to pick two stocks out of 5,000, 8,000 listed companies, I think these are the two stocks that investors are at this point of time rushing into, and that makes me a little concerned that it might have become too overcrowded and trade without too much to back in terms of fundamentals.
Well, there's a third stock as well, which I think you have on your watch list later in the day, but I won't take it for now. But CJ, what does it take to please you, man? The company has delivered on almost every front. You're really splitting hairs there.
You're 21 times, 21 times almost FY24 earnings. You have almost the best at this point of time narrative in the market in terms of the capex revival and all that. I have not even got to that part yet in terms of outlook. I mean, yes, the order inflow in Q2 was spectacular. Clearly, the company has been winning a lot of orders, and almost 33% of those orders came actually from the international book.
And one more thing, CJ, here. 59 basis point decline in net margins is not a huge deal given the inflationary environment that we are in.
But given that their margins are only high single digit, I think 59 basis points makes a spectacular deal. If these were margins in the 20-25% range, you could still forgive the management for facing the sort of cost pressure that they're facing. Of course, the entire picture could change in Q3, because you would see the low cost inventory of steel prices and cement prices maybe percolating into third quarter and fourth quarter, and then the margin picture could totally change. But at this point of time, it does not seem like. It seems L&T, at least in some of its projects, is still holding a high cost inventory, and I think that is what is probably affecting the margin game at this point of time. And as far as order inflow is concerned, Santo, the worrying thing is that 33% of the orders came from international book, right? Now, internationally, we know how the global macro setup is right now. Yes, L&T is benefiting from the higher, the exposure that they have to the Middle East, where higher crude oil prices tend to, be positively correlated in terms of order inflow for L&T. But with crude oil at this point of time, being lackluster, apart from that, the recession fears that we have, in most sectors globally, and also let's not forget that festival demand in India has largely been led by the urban sector. there are now, concerns rising that if rural sector does not, the demand does not come through, it could force a lot of corporates to rethink some of the capex plans that they have been, talking about, even though none of them have been executed so far to that extent. So that capex revival theory also could come under question in FY24 if we do not see a meaningful revival in rural demand and domestic consumption overall.
That's a hard-fetched theory, but be a little more optimistic, CJ. Anyway, L&T is also likely to be one of the big beneficiaries of the national infrastructure pipeline, close to about 1.1 trillion worth of orders out there.
Absolutely. I think, Santo, if in terms of visibility, clearly there is no doubt that given this is being led largely by the government's capex plans, government's infra plans, we'll have to, of course, if you were an optimist, you will argue that without the government's, capex engine, going full hog in the first half of FY23 so far, the company has managed quite spectacular, numbers in terms of order inflow in H1. But now with the government capex engine also going full throttle, maybe order inflows will improve even further. And I think that is one of the reasons why the management indicated that they could be, nearing the top end of the band or the guidance band that they are given. And that is well and said. But I think there are still some risks, especially with the fact that this stock is becoming too overcrowded and there is too much optimism at this point of time.
Well, let's get into the market setup, CJ.
Well, Santo, the setup looks quite rosy as, of course, the L&T earnings, the SGX Nifty 50 futures are indicating almost a 100-point gap up opening for the Nifty index. So clearly, we are going to break past that 18,000 mark, and now the 18,200, the resistance that you have been talking about for weeks, Santo, I think that now comes into play. That said, the cues from Wall Street actually were quite muted. Benchmark indices there actually did fall on the back of some weak earnings from the communication sector, as well as the jump in US 2-year and 10-year bond yields that we have seen. Bond yields did rise ahead of the US FOMC meeting outcome. It seems that the market is starting to price in even higher interest rate, and that theory that there could be a rate cut in March, I think that is struggling to find buyers at this point of time in the market, Santo.
Well, people just won't listen to what the Fed is actually trying to say. They make their own theories. Anyway, that apart, I think the overall macro setup too is quite positive. If you look at the September core sector data, which is at a 3-month high, bank credit, which is up 17% for September. So overall, the mood, there's plenty of indicators, macro indicators to support the kind of rally that we are seeing in the market at this point in time. And we're seeing some outflows from domestic institutional investors, which I think has largely to do with the fact that many HNIs who invest lump sum when the market is at lower levels, they are probably booking profit. This is a trend which has been quite dominant over the last year or so, according to fund managers. We're seeing short build-up in futures of Petronet, LNG, Intellect Design. Intellect Design took quite a bit of a beating after those disappointing second quarter numbers. NMDC and Bandhan Bank. Long build-up are being seen in futures of Ramco Cement, Trent and GSPL, and delivery volumes have been higher than usual in TCS, Godrej Consumer, Marico, Biocon and HCL Tech.
Well, Santo, moving on to the newsmakers of the day, and the first one is actually a surprising one for me because I did not see this sort of a performance coming in from Equitas Small Finance Bank. The company has really trounced estimates as far as the street is concerned. Numbers for the second quarter came in above Moneycontrol's poll, even CNBC's poll. So clearly a very strong number. If you look at the net profit, that jumped over twofold in the second quarter. The net interest income rose almost 26% on a year-on-year basis. Apart from that, very crucially for Equitas SFB, the asset quality improved. The gross NPA ratio fell to about 3.9% from in excess of about 4.1% in Q1. So clearly the macro finance segment, which has been talked about by a lot of even banking sector experts, Santo, that the growth there seems to be very, very strong at this point of time, apart from, of course, housing and unsecured retail loans. Clearly, Equitas is at this point of time getting out of the shadow of the COVID-19 pandemic, when microfinance was probably the no-go zone for investors, and now I think you could see a lot of traction in the stock today.
Well, the stock already has seen a good run up somewhere. I think in the mid of September itself, early October, it started rallying quite a bit. I think market has already been anticipating it, and to some extent, I guess the upside would have been captured. Bharat Electronics is the newsmaker on my list. The company has raised the lower end of its FY23 margin guidance, and now the margin is seen at 22 to 23%. Earlier it was 21 to 23%, and the company has said that it will achieve the 15% revenue guidance that it had set out earlier, and it expects second half turnover to be better than that was witnessed in the first half, and it's also received a letter of intent for about an 8100 crore order for battery pack.
Well, before we move on, guys, keep posting your comments and your stock queries on the comment section. You can utilize the hashtag AskMC, and of course we will keep on taking them throughout the show and to in the coming days as well. That is, Santo, what is your top brokerage bet for the day?
Well, it's Indus Towers by Motilal Oswal Financial Services. Motilal has a neutral rating on Indus Towers with a target of 197 rupees. Now, according to Motilal Oswal, it estimates the revenue, EBITDA and net profit to grow by just 2% between now and FY24. And while it has said that dividend yield makes it look quite attractive, but the management itself has said that the future dividend payouts would hinge on cash flow, free cash flow, which at this point in time, according to Motilal Oswal, is quite suspect.
Well, Santo, my top brokerage bet today is CDSL from JM Financial. They have kept a hold rating and a target price about 1230 rupees at this point of time. They are suggesting that although the IRDAI's move of insurance demats, that is going to create opportunity, a sales opportunity for CDSL, but the competition that it may face from CAMS, actually, given that CAMS has so far been a one-stop solution as far as insurance policies are concerned, I think that could probably curtail the opportunity size that CDSL could have. Apart from that, the brokerage is also concerned that the weak global macro environment could percolate into weak capital market action, as we have been seeing in the first half of FY22, and therefore could slow down CDSL's growth. Therefore, JM Financial believes that the peak earnings growth that we saw in FY22, or the earnings growth that we saw in FY22 was probably the peak for CDSL in at least the next 1.5 to 2 years.
Well, and with that, let's go on to the stocks on our watch list, starting with Tata Steel. CJ, fairly disappointing set of numbers there. The India business was strong, but that was offset to a large extent by the weakness in the European business, and that looks to be the case for some more time to come, given that operating costs are higher in Europe because of higher energy prices. Well, we'll get to that in a minute. Before that, let's take a quick look at the markets. 82 points up on the Nifty. Nifty now at close to 18,100.
Wow.
Well, we are seeing good strength.
Yeah, edging closer to that record high, Santo.
Yes, not record high. That's 18,600
no,
is the record high.
I know. We are edging closer. We are just 400 points away. So it's just what, 2% more, I think, 2.5% more.
There's many a slip between the cup and the lip. CJ, we have seen this happen many times in the past also. Market breadth fairly strong at this point. 1,451 stocks up on the NSE and 450 stocks down. Reliance among the key gainers in early trade, up about 1%. ICICI Bank is also up by about close to 1%.
Yeah, and even sectorally, Santo, I think in almost the entirety of the sectoral analysis on Nifty are in the green at this point of time, except for Nifty Metal, which is probably down largely because of the weak earnings from Tata Steel. But if you look at the Nifty IT index, higher by about 0.7%, Nifty Bank 0.6%, Nifty Auto doing again, adding to its outperformance for this year, higher by about another 0.5% at this point of time, and the Nifty PSU Bank Index also doing quite well, higher by about 0.6%. So clearly, it's a broad-based day of gains for, or at least the start for the market, and we will have to wait and see whether this sustains or not, because we also have the automobile data coming in for the month of October. It will be very interesting to see if the auto pack can continue to charm investors as it has done all throughout 2022.
Well, CJ, coming back to Tata Steel now, the India business was good, but according to the management itself, the realizations were still lower, and demand has been stable, and the outlook is quite moderate at this point in time. It's not a very upbeat outlook very clearly. Also, CLSA has downgraded the stock to a sell with a target price of 90 rupees. Earlier, the target price was 100 rupees.
Clearly, Santo, I think the numbers were disappointing, and as the street was expecting it, given the fact that that export duty that was imposed back in May by the government clearly has taken its toll on not only the export side of the business, but as well as the domestic prices as well. That said, I think the margins for the India business should start seeing an uptrend going ahead. Even though it may not be a full recovery, I would expect that the margins will start recovering from Q3 and Q4, largely because there is a perception, at least within the industry, that probably prices or domestic steel prices might have bottomed out in Q2, even though, of course, there are divergent views as far as analysts are concerned. We have almost seen a 20-25% correction in domestic steel prices, and it seems like the worst probably could be behind as far as that is concerned. Also, the key trigger for now, going into the second half of FY23 will be the revival in demand. Whether we see an uptick in demand largely led by the construction sector, government capex, maybe, hopefully, even private capex, that remains to be seen, because if we do not see demand revival coming in, then the capex plans that a lot of companies like Tata Steel have as far as the domestic industry is concerned, that could come under pressure. And of course, the European business now has become the headline issue because of the sort of weak numbers that we have seen from Europe and the recession fears there. Clearly, Europe will be something that investors will be watching out very closely.
Just a couple of points here.
Yeah.
Now, CLSA has said that steel prices, domestic steel prices, could weaken further even from these levels, because they are still at a 12 to 16%.
I find that very surprising, because it seems, that's why I said there are divergent views. Because if you look at some of the reports that have been coming out of Nomura, they have not really seen any further weakness. I mean, after the 20-25% fall that we have seen, they are indicating that it's largely, it seems like a lot of the fall has now been taken care of, and therefore incremental decline in steel prices could be very difficult. This is something, a view that even JSW Steel was sharing with CNBC TV18 earlier this month, when they were talking about domestic steel prices, and they said that they feel that we have seen the extent of decline that we had to see after that export duty was brought in. Now, of course, the price will be a function of demand more than supply, because if demand does not catch up and demand remains muted, then of course steel companies will be forced to take further cuts, provide further discounts in order to boost volumes. And I think that is where I think the key trigger for stock performance could lie as far as the steel industry is concerned.
Yeah, raw material prices may ease a bit, but if your overall realizations are not going up in a big way, then you won't get past the earnings.
In fact, actually falling raw material prices could be negative in that sense, because steel companies would love to have higher raw material prices, because they can then pass it on to customers, and that enables better realization. But let's see how this turns out, because clearly at this point of time, the sentiment on the street for the entire sector, leave alone Tata Steel, seems to be on the downside. Well, the last stock on my radar today is Bharti Airtel, a stock that has continued to perform as far as earnings are concerned, even though the market is still not willing to buy the argument. I mean, yes, the stock has been doing relatively well compared to the rest of the market, but the outperformance that we have seen, say for the likes of ICICI Bank or an L&T or an SBI, we have not seen that sort of an outperformance for Bharti Airtel. In fact, a lot of the analysts out there have been contrarian, in the sense that even the stock performance has been okay-ish, they have been downgrading their earning estimates for some reason. That said, if you look at the strong operating performance for second quarter, I see no reason why this stock should not be outperforming. The Q2 ARPU came in at 190 rupees, which is now edging closer to their target of 200 rupees for FY23, and it seems like they will achieve that target much ahead of time, Santo. Overall, Bharti Airtel did indicate that there is requirement for another tariff hike. So I am guessing that probably by the end of this year, or maybe in the beginning of 2023, we could see another tariff hike coming in from the industry. And now, of course, as for Reliance Jio, all the eyes will be, or all the focus will be on the execution of the 5G launch, and what sort of pricing do we see, whether see a competitive pricing environment from Bharti Airtel and Jio, or do we see the sort of maintenance of stability that we have seen in terms of pricing in the 4G space that percolate to 5G as well?
Well, no disputing the number that it's very hard to make a case against Bharti Airtel at this point in time, given that there's been a significant improvement in the operating performance, and that apart, the stock too has rallied by more than 33% over the last 3 months alone. So there is a lot of appetite for the stock, even though analysts are divided, and that's what I find a little surprising. My only point at this stage would be that given the sharp run up, you might see some kind of profit taking, which could then again limit the upside in the stock for the time being.
That's Santo, your last stock?
It's CCL Products, decent set of numbers there. The volume growth has been, CCL Products is Consolidated Coffee Limited. robust set of second quarter numbers there. Volume growth has been close to about 20%, and according to analysts tracking the stock, the energy crisis in Europe has been driving business to some of the other countries like India and Vietnam. Antique Broking is one of the brokerages which is bullish on CCL. It has upgraded its price target on CCL from 520 to 560 rupees. Now, it's the main triggers for the stock according to Antique is that new client additions, also increase in capacity additions, and the fact that the company has been having good optimum capacity utilization at its existing plants at the moment. So, these are some of the triggers that could keep the stock in the limelight.
Yeah, and I mean spectacular earnings and also spectacular commentary. I mean the management had already raised their guidance for volume growth to about 20 to 25% in this on the back of very strong numbers in June quarter, and that commentary has continued even if you look at the second quarter as well. Santo, so clearly as far as the earnings momentum is concerned, that is now with CCL products. But I'll just point out a few of the risks that probably could derail this outlook at this point of time, and that risk of course stems from the very high inflation that that is expected at this point of time in US and Europe. If that continues, I think that could eventually pose threat to the sort of volumes that the company is at this point of time taking from its North American sales as well as European sales. Apart from that, technically also, Santo, at this point of time, the stock appears to be a little overbought as far as the relative strength index is concerned, and therefore I would not be surprised that investors choose to take a little bit of profit after a very strong run up and a very strong earnings performance, and that is very natural when a stock is in an uptrend as CCL products is over the past 6 to 7 months. So I think some bit of consolidation probably could be called for and may actually be a good thing for the longer term investors. Well, that's it, Santo. Let's quickly take a look at what our viewers have been asking us, and I think this would be interesting because I think the company is also going to post their earnings tomorrow. So Prahlad Singh wants our thoughts on SBI, State Bank of India.
Well, when it comes to the banking sector, given that right now the overall mood is quite positive and it is back, there's good reason for that. You're seeing some strong credit numbers across the board, and ICICI Bank and SBI, these are the two stocks which right now most are on the buy list of most analysts. And for SBI, the biggest thing in its favor is that valuations are still reasonable at a little over 1 time book. So in that sense, there have been legacy issues which have really held back the bank, but most analysts tracking the stock now feel that time is now due for a re-rating, and valuations are the most supportive at this point in time.
Yeah, I mean, as far as credit growth is concerned, clearly the picture is very, very strong for SBI, but I think the only question mark could be on NIM Santo going ahead, because it seems like the banking industry is walking into a sort of a very tricky situation. We are trying to gather deposits, although gathering deposits for SBI has never been an issue and it will never be an issue. But overall, if you look at it, deposit rates have been rising, but at the same time, the sort of offsetting effect that rising bond yields are having on the treasury income, I think that could be concerning, because overall at this point of time the market is not sure that we have seen the top as far as the 10-year government bond yield is concerned, and if losses there continue to rise, that will offset the sort of the benefit that they are seeing from the write back of provisions that they probably would have made in the bad loans earlier in the previous quarter. So I think overall margin, apart from the margin issue, everything else at this point of time is looking very, very good as far as SBI concerned, and even the entire, you could extend our argument probably to the entire PSU space at this point of time, Santo. Lastly, one of our viewers wants our thoughts, I think, on this is a stock PNG Health, Santo. This is of course Procter and Gamble, the almighty stock of the old ages, and you would remember this when you had joined probably journalism. I think this used to be part of the benchmark indices, and now of course this is one stock that has fallen off probably a lot of investors' radar, especially within the FMCG.
We don't hear about it, and sorry to say, I've not really tracked this stock, so it would be difficult for us to give an
I mean, as far as I know, I think PNG's growth profile has been struggling. Clearly, it has fallen as far as the investors' pegging order is concerned. It has really fallen off the radar for a long time now. That is largely due to the fact that volume growth as well as market share of PNG has been suffering in the past few years, and it has not been able to recover a lot of that market share. It is almost on, I mean, the story is almost similar to the way Colgate Palmolive is, Santo. I think there also Colgate also, the concerns have largely been on market share because of the the move or the trend towards a holistic approach to oral care or any other thing you talk about. I mean, the rise of Ayurveda, the rise of self care. A lot of people, a lot of companies like P&G and Colgate have been suffering because of that. And clearly, I think you can see that in the earnings as well.
And the margins too have been steadily shrinking, and that I guess is one of the big concerns of the market, which also explains partly why the stock has fallen so much.
Well, I think, Santo, we should wrap it up, and we'll, of course, those who have not had your question answered, we will definitely take it up in our upcoming shows. You could find that in our stock takes. We generally tend to take up your thoughts and your queries in our stock takes as well. So be rest assured, we are not ignoring you at all.
Well, and it's a wrap, and please continue to send in your queries. We do really enjoy it.
Yeah, and absolutely. And guys, you can keep following us on the social media links that you can see at the bottom of your screen. And for the rest of your financial news, you can always stay tuned to moneycontrol.com and download the Money Control app. We'll catch you live again at 3 p.m. Till then, have a great trading day.